Well, Santanu Chakrabarti is India analyst, BFSI, BNP Paribas. We talked about, of course, the numbers from Reliance. The others were, of course, HDFC Bank, ICICI Bank. Let's start with ICICI. Santanu, there is, of course, the numbers, and then there is the extension to Mr. Bakshi for another 2 years, which I think does bode well in a sign of strong confidence, right, for investors. How do you see it, and what's the view on ICICI Bank as a stock from here?
So it's our second most preferred bank next to HDFC. And my only worry in the near term is that given the standards it has set for itself as kind of the bellwether for the sector, a slightly lower growth number in retail loans and savings accounts, maybe 2 straight quarters of weakness, might precipitate some weakness in the particular counter. But we remain very constructive about its prospects over the next 12-month period, and definitely the the leadership continuity bit should bode well. And given the track record that the bank has put up in the last 3 to 4 years, all I'll say is that bulk of the market was actually probably expecting the continuity to play through, because in a lot of ways ICICI Bank has set the standard for steady performance over the last 4-5 years.
ICICI Bank, though, has underperformed in the last 6 months. I know the start of the year has been good, but 6 months, Nifty Bank is up 5.5%, while ICICI Bank is down 3.5%. So the underperformance is to the tune of about 9%. Pretty stark there. Santanu, what about HDFC Bank? Stock went into its earnings with considerable amount of weakness. How did the numbers fare versus estimates?
I think, at the top line level, it was broadly in line with what the street was expecting, maybe 1% here, there. Definitely the growth coming in at about 12% had set up the stock well for its NII number. And the fact that margins actually expanded quarter on quarter shows that the basic thesis of this bank still have a fairly suboptimal liability structure thanks to the merger, and that gradually unwinding in terms of refinance of high cost NCDs, etc. That story stays alive. And in the next quarter we expect margins to correct for most banks, but the fact is the key part of our thesis, and I think the key source of optimism around HDFC's re-rating is a benign and gradual tailwind to margins, as both the effects of easing on the liability side come through, and also its particular high-cost liabilities expire over a period of time. And that thesis seems to be in play. I mean, as far as the bottom line positive surprise coming from a right back is concerned, I think just like the credit cost inching up happened in ICICI Bank, in both cases market will probably look through that part of it, and I expect both stocks to react basis the performance around margins and specific loan growth categories.
Yeah. No, so Santanu, second best idea is you said ICICI. What's the number one idea?
HDFC.
HDFC. Okay. Okay. So this morning, maybe is there anything to do given moves anticipated, Santanu?
Yes, I think, especially in ICICI, despite the good news around management, the fact that, and you were alluding to it yourself regarding the underperformance in the last 6 months. See, the trouble is that when, you have the kind of performance as a bank that ICICI has had for the last 4 to 5 years, valuation and expectations of the market move to a slightly different stratosphere. And against that, if the numbers, even at an aggregate level, are a little weak, which they are for ICICI specifically for, say, retail loan growth and savings account accumulation, then that could provide buying opportunities for investors going in today. As far as HDFC is concerned, given that it had already traded fairly weak, I don't think these numbers are going to precipitate much of a disappointment. If anything, it should act as a little bit of a positive surprise.
Santanu, now that's ICICI and HDFC Bank. Federal Bank reported numbers, right? And stock really did very well post the numbers. PSU banks are doing phenomenal. Union Bank, for example, and others will report. So just from that cohort, what are the top ideas here? The PSU Bank index, by the way, last week was up 5%.
So, we have a neutral on SBI, and my main argument here is that I understand that PSU banks are placed fairly well. But when I look at the capital productivity that a PSU bank typically delivers, and SBI can be a great example to look at, you'll understand that leverage plays a very large role within that. And the other thing that's playing a very significant role in terms of the names like SBI delivering a mid-teens kind of ROE is the credit cost number being fairly low. Now, that's a trend that overall for the banking sector, that level of credit cost, 25 basis point or 30 basis point is not really sustainable. So, there will be a moment of truth at some stage. Whether that comes the next quarter or the quarter after is hard to call. Where even without any major change in, broad asset quality or the fundamentals of the economy of the balance sheet, you are going to see credit cost normalizing back to, say, about 45 to 55 basis points. The trouble is that spells fairly strong erosion of earnings growth and a significant drop in ROE when the leverage itself is 14 to 15 times, which is the case for SBI and multiple other PSU banks. So yes, they are trading well, but given where their valuations are, this is what is restricting my optimism around them. I understand the market share gain part of the equation. I understand that there is nothing to be worried about in terms of their balance sheet health. But pure normalization itself will stunt a lot of the earnings momentum that market seems to be betting on so aggressively.
Thank you very much for joining in, Shantanu. Let's